Welcome back. Today we're going to talk about inventory. In this particular section in this video, I want to make very, very clear that we're talking about inventory that organizations use for generating revenues. If you have an idea of Walmart or Target or Kohl's, you can kind of get an idea of what I mean by inventory. Inventory in this case, we're talking about items that are already manufactured and ready for use and for resale. We're not talking about a manufacturing type of environment. That's a totally different concept of inventory, whether it be raw goods, raw materials, etc. We're talking about goods that are already ready for sale. So what's flying off our shelves? When we talk about recording our inventory, we're going to really talk about what we paid for it. That's all it is. A lot of times when we're talking accounting language, we make things a little bit more complicated and we add more terms than really are necessary. And the real basis upon which any item on inventory is on your books is going to be at the historical cost. How much did you pay to acquire that asset? Our inventory is used for purposes of generating revenue. So in this context, that's what we're talking about, inventory in the context of resale and generating of revenue. How much did we pay for it? So when we purchase inventory for sale or for resale, we're talking about our jeans or our clothing line. We're talking about possibly grocery items. We're talking about electronics, those types of things that would normally be seen in the Walmart or Target organizations in their inventories. So when we talk about those items, we also have to consider other types of goods that we might sell to our customers that we actually ship to them, in shipping costs and other costs that we have to incur to prepare that particular inventory item for sale. So when we would talk about how much does it cost and what are we going to record for our inventory, we have to consider how much we paid for it. We have to consider the value of the shipping that we had to pay in order to get that goods to us, and any other kinds of processing that's necessary to bring that asset to its full and intended use. That's essentially what when you're reading your chapter, what you should glean from that information. Perpetual method of inventory. I have to say, for the Walmarts and the Targets of the world, perpetual inventory method is a constant reshuffling and recomputing of the ending inventory. As assets, or in this case inventory, is purchased, you're going to update your ending inventory balances. As assets are sold or removed, maybe due to obsolescence or theft or shrinkage, the ending inventory is updated. It's a constantly updating or perpetually updating the ending inventory balances. And it's a very, very reliable way of doing it. And if you think about it in the real world, the Walmarts and the Targets of the world, when you're going to the store and purchasing any item on their inventory, you're going to have a bar scan code, and that bar scan code identifies that specific inventory item and removes it at the time of scanning off its inventory records. So at any point in time, in any time of the day, quite frankly, a Walmart or a Target can compute or generate a report that shows them exactly their inventory levels at any time. And again, most organizations still count inventory, and they use that as a method by which to compare, if you will, the ending balance that's based on a scanned transaction, i.e. purchasing of inventory gets scanned and selling of inventory and it gets scanned. But at the end of all of it is Walmart wants to verify that its accounting records, its automated tracking records of inventory compares with the actual physical count. And that's generally done once a year. That is the perpetual method of inventory. We are going to be computing ending inventory, calculating ending inventory all the time after every single transaction. Periodic is going to be mainly the process of doing an inventory count once a year, once a quarter, and you actually physically count the inventory that you have in place. This is highly inefficient, and which may explain why organizations like Walmart, with millions and millions of individual inventory items, why it's not done a lot, why it's made done once a year, because it's a tedious process, and in fact it may not be as accurate. but it is used and it is done and is performed and compared with the actual automated ending inventory calculations that's done. But the basic and most important thing is perpetual is a continually updating of inventory records. Periodic is done for maybe, I don't know, and I'll use inexpensive or unimportant items. I would say periodic inventory is going to be done when there are very few inventory items to check. It is not necessarily for inexpensive items, but I would say less voluminous. Walmart would never, on a daily or weekly or a quarterly basis, do a inventory count. And they most certainly wouldn't be having a periodic inventory tracking system given the complexity and the volume of inventory that flows in and out of that organization. But it's important for you to know the difference. FOB, shipping point and destination. We use these terms to help us determine how we record costs of shipping of assets. When an asset is being shipped to us, meaning we purchase from a manufacturer, and they have this FOB shipping point or FOB destination, that's really essentially letting us know when that point of sale or the ownership passes from the seller to us. And then why do we care about that? We care because for accounting purposes, it tells us when we need to record a transaction. We need to know when to record. Well, when the ownership passes to us, we know our transaction's been culminated. A transaction's culminated, we have to record it. And so it becomes important. So FOB shipping point means when they ship it out to you, you own it. And you need to record it at that point. However, if it's FOB destination, you only own that product, that inventory item, the moment it's received at your location. And there could be a timing difference. And it only is significant, in my personal opinion, when you're closing out the period or you're closing out a year. It becomes quite significant because you don't want to record your asset in the next year when you know in reality the FOB shipping point, that title passed to me. I own it. I'm responsible for it because it's my asset. And I need to record it the moment it is mine. It is my asset. That transaction is officially culminated. And that is regardless of when I've actually received it. So that becomes important. Next is cost of goods. So how much does it cost you to sell that item? So if we talk about inventory, we're talking about I purchased my inventory of clothing line for $1,000. I sell it for $2,000. My cost of goods sold is the cost that I purchased it, $1,000. I take the 2, which is my sale, and subtract my cost of goods sold to get my gross profit. Now, the cost of goods sold is going to be calculated based on the flow of goods, and we'll talk about all that in a minute. But the most important thing is cost of goods sold is going to be shown on your balance sheet, and it's going to be useful in us computing the gross sales, actually gross profit for our organization. And again, this is relevant to organizations like a Walmart and a Target. You may have cost of good manufactured in the context of a manufacturing organization. But for purposes of retail establishments, cost of goods sold is going to be the manner by which we determine how much we have, what profit we have earned on the sale of our inventory. Counting and adjusting inventory. Perpetual inventory method, you really don't have to do much because it's going to be constantly updating your ending inventory. It becomes important to note that when there is a counting of your actual inventory, and again, for most companies, once a year is all they can do. Quite frankly, given the level of inventory items, it's not efficient to do it any other time. You do have to adjust. Again, that has to do with if you do an inventory count based on your perpetual inventory system and you see that there is a difference, you have to identify why those differences exist. Could it be the difference is related to shrinkage, spoilage, obsolescence, or just downright theft? Nevertheless, we need to account for those differences and adjust inventory accordingly. Cost flow assumptions. We talked about FIFO, LIFO, the flow of inventory in and the flow of inventory out, first in, first out, last in, first out, average cost, specific identification. And again, an organization will use the appropriate cost flow assumptions that makes most sense and is most closely aligned to their own personal reality. Neither one are bad or good. This is what is most appropriate for the organization. And again, I don't want to go through all the details of that because I think you've read it in your chapter. The most important thing is the method that is used should closely align with the reality of the flow of your specific inventory for an organization. And I have to say, however, if you take a look at organizations that are large and they present their financial statements online, you'll see a vast majority will use a FIFO method rather than a LIFO method. But it is important to note that whatever method is used, it should very well be disclosed in the notes to the financial statements. And people who are looking at your financial statements are going to want to know what method you're using and why you're using it. So if you're using a cost flow assumption that's FIFO, you're going to note that when the prices are falling, you're going to deal with a lower net income and a higher cost of goods sold. And it's important to see what the effect of higher prices and how it affects the LIFO cost flow assumption and how it affects the FIFO cost flow assumption. Lower cost of market, again, I have not seen many organizations use this. I would assume then that you still should know exactly the differences among the three costing methods. At the end of the day, this is tracking your inventory based on what the market price is, resale prices, and what it actually costs you to purchase that asset. Again, costing flow method needs to be disclosed in the setup of financial statements. I'm going to show all of you an example of how to compute your ending inventory, your cost of goods sold, based on the costing methods we're covering in this section. But I suggest just read through the chapter, understand what the costing methods are designed to give you. We are using these methods to determine the cost of goods sold. So when you're using a FIFO method, what is it going to give you? It's going to give you the cost of goods sold, which ultimately will give you your gross profit. Thank you so much for your time, and I hope to talk to you in the next video.